Let's talk about the accounting for stock investments. When a company buys stock of another company, they are making a purchase of a stock investment. How much of the other company's stock that is purchased will determine how we account for it. If we purchase less than 20% of the other company's stock, we are considered to have insignificant influence on the other company. We will use the cost method to account for the investment. If we purchase between 20 and 50% of the stock of the other company, we are presumed to have significant influence, and we will use the equity method. If we purchase more than 50% of the stock of the other company, we are assumed to have a controlling interest, and we will present consolidated financial statements. When we purchase less than 20% of the other company's stock, we use the cost method, which says we record the investment at cost, and the revenue we recognized is only done when cash dividends are received from the investment. For example, on July 1st, ABC purchases 1,000 shares, a 10% ownership of XYZ common stock. ABC will pay $40 per share for that stock. The journal entry would be to debit the assets stock investment account for the total cost, 1,000 shares at $40 a piece, or $40,000, and credit cash for $40,000. If dividends during the year are earned in the amount of $2 per share, the cash dividends received would be debited to cash, 1,000 shares at $2 per share, debiting cash for $2,000, and credit dividend revenue for $2,000. When that investment is sold, if ABC sells its investment for $39,000, the stock or the investment had cost $40,000, this company will record a loss because the investment was sold for less than its cost. The February 10th journal entry will be a credit to the investment to decrease it, debit cash for the $39,000 received, and the difference of $1,000 is debited to the loss on the sale of stock. If we purchase stock and we own between 20 and 50% of the other company's stock, we will use the equity method. We will record the investment at its cost, and then we will adjust that investment for any earnings or our share of the earnings of the other company and any dividends that we receive on that investment. For example, ABC obtains significant influence over XYZ by buying 40% of XYZ's 60,000 outstanding shares of common stock at a cost of $12 per share on January 1st of 2020. On April 15th, that company declared and paid a cash dividend of $45,000 in total. The end of that year, XYZ reported net income of $120,000 in total for the year. ABC would need to record the following entries. On January 1st, when the investment is purchased, it would be the number of shares that the company XYZ has in total times our percentage purchase, 40% of the total shares, at a cost of $12 per share. $288,000 is recorded as our investment, crediting cash $288,000. When the dividends are paid by XYZ, XYZ is taking some of the value of their company, some of their retained earnings or some of their accumulated earnings, and paying it out to investors. Thus, the value of the company is decreasing and the value of the investment to ABC is decreasing. So the total amount paid, $45,000, 40% of the dividends belongs to ABC. So ABC will receive a cash dividend payment of $18,000, which decreases the value of its investment by $18,000. So we will credit it $18,000. Finally, at the end of that year, when XYZ reports income of $120,000, ABC is really earning 40% of that. Thus, we will increase the investment by the percentage of our ownership of the income of $120,000 or $48,000 and record the revenue of $48,000. Thus, the original investment is decreased by any dividends that are paid, but increased by our share of the investee's income. If we were to purchase more than 50% of another company's stock, we would be considered to have a controlling interest. We would be referred to as the parent. The investment or the investee would be referred to as the subsidiary. The parent would prepare consolidated financial statements, which takes the financial statements of the subsidiary and consolidates them and reports them along with or in our financial statements.